Okay. Hello, everyone. My name is Katerina Marie Kalivodova, and I work as a legal counsel at Great Impact Finance. I am a rotating member of the credit committee, and my tasks are to analyze loan applications, weigh out the pros and cons, and give legal advice. I apologize for not being able to attend the meeting in person, but I had some last-minute work commitments that I had to attend. And so me and the other members of the committee decided that I will at least provide you with a video presentation. Today, I will be discussing an application submitted by FinTech Innovations Limited. The agenda for today is to introduce FinTech and their application, provide a thorough analysis of the collateral package and the risks, enforcement and perfection of the package in FinTech's jurisdiction, and lastly, voice my concerns and provide advice. To start, FinTech is a Switzerland-based company working in the tech industry, and their goal is to revolutionize financial services. They're asking for a loan of 2 million euros with 8-year repayment term with monthly interest payments. The prime rate plus 1.25% is the initial rate. However, it's subject to change based on market conditions. The loan is intended to be used for technological advancements and market expansion and outreach. FinTech is interested in pledging the following collaterals, which is intellectual property patent, founder's personal guarantee, and second-rank mortgage on office property. Firstly, intellectual property is an intangible collateral. FinTech's offer of the patent on its algorithm is a great way to show the uniqueness of its mobile banking platform, which also enhances its value. Additionally, patents hold legal protection, but it is considered a low-quality collateral as its nature and monetization only hold value for the borrower as the ownership rights aren't transferred, and monetization for the bank would be difficult in the case of default. Pledging intellectual property requires careful determination of its value, which companies usually hire an expert to do for them, and additionally, a determination of its marketability in the case of default. Because in the event of default, realizing value of such collateral might be challenging and is uncertain whether it would cover the debt. So secondly, we have founder's personal guarantee on the tangible collaterals. So the two founders of FinTech are offering their luxury automobiles and real estate. I believe this showcases immense commitment and confidence in the venture's success. However, the adequacy of these personal assets to cover the 20% personal guarantee should be carefully evaluated. The real estate and luxury automobiles markets are both fluctuating, and the founders should consider doing regular evaluations of the market value to ensure that the collateral is still adequate. Furthermore, the founders should consider whether they have financial stability and no debts, as the seizure of these assets could result in further debt in the case of default. Lastly, the second-rank mortgage on office property. This pledges a significant commitment. However, it also has significant risks. Since an international lender has the first-rank mortgage, it will take precedence over the second rank and cause a risk in the case of default. Because if the first-rank mortgage holder was to retrieve it, the loss of collateral would be irretrievable and could load up a debt. So once again, the founders should assess whether they are financially stable or not. I would like to talk about the perfection and enforcement now under Swiss law. So because FinTech is a company based in Switzerland, they have to comply with the Swiss law on collaterals and pledging. Switzerland has the principle of possession, which gives the owner ownership while the lender will have possession. This principle requires a written pledge agreement that is valid to the parties of the agreement and provides for security of the bank. In short, if FinTech wants to pledge an object, like the luxury automobiles, they have to give the bank full control over the object. Under the Swiss law, FinTech has to give the bank a thing called security, and valid security requires a security agreement and a perfection of the security interest. The security agreement has to be signed by both the FinTech and the bank. Perfection for movable assets is achieved through a declaration of pledge or delivery of the movable assets. However, I will talk more about perfection for the individual pledges. Intellectual property is considered rights and claims under Swiss law, and security over shares and receivables, which are rights and claims, require no notarization, registration, stamp duty, and there are generally no other fees that apply. However, FinTech may voluntarily register security over intellectual property with the intellectual property register, which comes with registration fees, but it will provide FinTech with protection over third parties acquiring the intellectual property rights. Security over real estate requires a notarization deed for which notary's fees may arise. The luxury automobiles pledge will only be valid if the bank is in possession of them under Swiss law, as was already previously mentioned. This applies to all tangible movable property. And so if the FinTech founders retain exclusive control over these automobiles, the pledge cannot be perfected, and it can only be perfected if the bank is in control. Security over second-rank mortgage is taken by way of mortgage or mortgage note. Both types of security require the conclusion of a mortgage agreement, and it has to be in the form of a notarized deed. For perfection, the mortgage or mortgage note has to be registered in the land registry. For certified mortgage notes, the bank also needs to have the possession of the mortgage note under Swiss law. My concerns regarding the collateral package are that I don't think FinTech would be able to cover all costs in the case of default. As I already mentioned, each pledge has its risks, and I believe everything should be reconsidered before FinTech offers these up as pledges, because the patent doesn't have a second market desirability, and it's difficult to determine its liquidability as well as its market value. 20% personal guarantee of the founder's assets are also a bit problematic, as real estate and luxury automobiles markets are fluctuant, and additionally, the 20% would not be enough to cover costs in the case of default. Furthermore, even though it's only a 20% guarantee, the founders are still required to give the bank possession of the automobiles as well as the mortgage note under Swiss law, if there is any. And lastly, the second rank mortgage has high risks as the international lender has priority, even in the case of default. And even though the variety of the collateral package is sufficient, the nature of it is what's risky and possibly not enough. So my legal advice for FinTech would be to carefully reconsider and seriously make a few changes to the collateral package, with the patent value be examined by experts, the personal guarantee potentially increased, and maybe an alternative option for the second rank mortgage pledge found. Thank you so much for your attention. I hope to have provided you with enough information. And if you have any further questions, do not hesitate to contact me. I have provided my email, and I hope you have a great day.